is some historical tendency for major tops for the insiders to hit the exit, all while the public is piling into these stocks. Take that for what it is. We see it as another sign of a speculative kind of blow off top here that probably will continue to run, but it's a very notable warning sign. Hello, everyone. This is John Llodra. I'm a co-founder and partner here at New Harbor Financial Group, here for our weekly market video. Purpose of these videos are to bring some data and insight, really for the purpose of educating and empowering our clients and viewers about markets, the economy, and certainly their personal financial situation. Today is Thursday, March 28th, 2024. It's the last trading day of the first quarter of 2024. Markets are closed tomorrow in observance of Good Friday and the Easter holiday. So it's been quite a remarkable start to this year in markets. I want to touch upon some of this. Yesterday we closed essentially at new all-time highs in the S&P 500. Market's been very, very strong, and there's some really interesting and frankly concerning things going underneath the surface. But for now, we see a tremendous freight train of momentum that's levitating a lot of things, most everything, frankly. So I want to jump right in here. I'm going to cover some market observations. I'll put that in the context of the big picture, but also the short term. I want to cover some trades we've done, positioning in client accounts in light of the situation. And at the end of this video, I'm going to touch upon the concept of income investing for income, which sounds really appealing, especially to retirees, and it can be a very powerful way to invest. This is kind of a preview. It will be a preview of a educational series that we're in the process of putting together on the topic of investing for income. It's probably going to be a 4 or 5 part series that we'll put out really in the category of educational content. So again, let's talk about the current markets. As I mentioned, markets closed essentially at all-time highs in the S&P yesterday, Wednesday, the 27th of March. And one of the main headlines of today is some recent IPOs that have been really catching attention. Certainly the price behavior of these IPOs has been quite dramatic. So of course, the IPO of note is Reddit. This headline, as you can see, Reddit ignites meme stock resurgence. Further signs of a bull market and everything. This is classic topping behavior when you see high-profile, meme kind of IPOs like this catching attention and catching the price action that it has. I'll scroll through here. Reddit, as many will recall, became synonymous with the meme stock rally of 2021. The whole GameStop spike higher in the price, the Wall Street Bets channel on Reddit, and the infamous Roaring Kitty and kind of the really dramatic behavior that was incited as a result of some of the chats on Reddit. Well, Reddit itself has been quite an eye popper of an IPO here. Not a good sign in our frank opinion. And that's also right around the time. So another IPO kind of thing that launched this week was the Trump Media and Technology Group under the symbol DJT. That wasn't quite an IPO. It was more of a merger of an existing Trump enterprise company with a special purpose acquisition company that was formed in 2021, I believe. But in both cases, the price behavior has been pretty eye-popping. For example, Reddit, the IPO price was priced at $34 a share at the high end of its anticipated range. It opened at $47 a share on trading. I think trading starting on Monday of this week, if I'm not mistaken. That was a 38% bounce just at the open. It traded as high as $75 a share this week, which is about 120% gain from the IPO price. And right here, as we speak, pre-market, it's trading around $55 or so, up 62% from its open. But the ranges have been dramatic. 30% plus intraday ranges have been the norm in that IPO. The DJT ticker, that was up 50% on the first day of trading, I believe, and it's been quite volatile ever since. These are two very interesting barometers of the sentiment of a very speculative, very momentum-driven market. And that's not really a good thing from a historical standpoint. I do want to highlight that this behavior, this all-time high behavior, is happening in parallel with a notable rise in insider selling. Essentially, insiders of companies have started hitting the exits. Quietly some, but for some more noticeably. This is a chart that shows the ratio of insider sellers to buyers. quite simply, it's logical that if, in the know corporate insiders are selling versus buying their own stock, that says a lot. And you can see right here, so far this year, the ratio is pretty high. And that's these orange or red bars. The blue line is the index, the NASDAQ index. So interestingly, you look at Reddit, that IPO that has skyrocketed. Many of the insiders are dumping their shares here. Now, that's not uncommon for insiders to sell shares once a company goes public. One way to look at that is they've earned the right to translate some of their corporate value into other diversified assets. But we're talking about a company here that has negative earnings. Many people really question if they can ever really become profitable. And it's just another sign of a kind of a speculative blow-off top, which we take as a warning sign that needs to be heeded. I want to share some data just to put the current market in context. We believe, unabashedly in a real big bubble, one that will probably in the very near term continue to expand a little bit. But make no mistake about it, we think being very cautious and conservative here is appropriate. I want to share our Twitter page just so I can highlight a couple charts that one of our very favorite analysts, John Hussman, has put together. His latest piece titled Universal Capitulation and No Margin of Safety. Really encourage folks, especially those that want to see really great data, to take a dive in. But I want to highlight a couple of the charts that he points out, or he's put together. This is a chart of valuations, and this goes back to essentially the Great Depression, right? This is a valuation metric that is very highly historically correlated with prospective returns, meaning when this is high, prospective returns are really bad or disappointing, and vice versa. Here we are today. The only times in history that we have been at the valuation war right now is at the very end of 2021 and right before the Great Depression. We've even eclipsed the tech bubble of 2000, and we're quite a bit higher than the peak in 2007, right before the housing crisis. It's tempting to believe that this bubble, so to speak, has been fueled just by a super short list of large cap stocks, the so-called Mag 7s and whatnot, and NVIDIA and those kinds of stocks. But actually, this is a great chart that Hussman and his team have put together. If you look, the value overvaluation is broad and almost across the whole market. This chart shows price to revenue ratios, looking at the S&P 500 broken into 10 valuation deciles. So super high valued stocks and super lower valued stocks here, relatively speaking, within the S&P 500. And in each case, see almost every decile is essentially at or near its all-time highs in valuations. In many cases, eclipsing where we were in the lead up to the tech bubble. So that's on a valuation stratification. If you look at it on a market cap stratification, same thing you see here. The largest 10% of by market cap, the median by market cap, and the smallest, all at really extreme valuations relative, certainly, to their own history. So check this out. I invite folks to follow our Twitter page. We don't put a lot out there, but what we do, we think is very germane and hopefully helpful. Our Twitter page is at New Harbor Fin. But so we're in a very overvalued market, but one that is a very powerfully driven momentum market. So we are reluctantly, I would say, more in stocks than we otherwise would want to be by valuation metrics. And Hussman himself would point out that valuations are very poor short-term timing indicators. They're great longer-term return indicators, but short-term they're almost useless. But what they do is they set the backdrop in terms of how you should be managing for risk. And I'd like to highlight that through a couple of trades we've done. We're about 40% or so in equities for most of our managed accounts in our flagship core model. And we've done some trades this week that I'd like to highlight. And basically, a couple of things we've done is we've moved some hedges up that we have on the S&P 500. We have some put options on the S&P 500 to hedge if we do get a pullback in the markets. So I'd like to share a chart just to kind of show what we are doing and have done there. So this is a daily chart of the S&P 500. I'm going to hide myself there. Basically, here we are. You can see essentially at all-time highs. These dotted lines are the strike prices of put options that we have had in place over the last several months. This goes back to the market bottom in October of 2023, and that was at 4,100. These are levels that we have essentially set insurance protection, if you will, through put options on the S&P. Just yesterday, we moved those put options up from 4,700 to 4,900. What that means is it's kind of like a safety net. As the market has advanced here, we have raised our safety net so that if we want to try to ride this market higher, because we do think in the short term it's likely to continue to exhaust itself, but go higher. And we want these hedges in place to protect our clients should that happen. So yesterday we moved those up from 4,700 to 4,900 on the S&P. And you can see we've successively moved these up as the market has risen. That we think is a very prudent way to keep our clients in the game, so to speak, but not take a bunch of risk of a major pullback in the markets, which we have a very high confidence is bound to happen. Can't time it with any kind of precision, but we think it's bound to happen. So this allows us to kind of have it both ways. The other thing I want to highlight is we did add a little bit of equity exposure in small caps, small medium caps, using the Russell 2000. I'm going to zoom out here to a weekly chart. So as broadly overvalued as the large cap indices like the S&P 500 are, the mid cap indices have been somewhat laggards. And the Russell 2000 is an example, but we had a very important breakout here in recent days and weeks. And we just yesterday, and will continue today, added about 5% exposure to this index for our flagship client managed accounts in our flagship model. But we did so with very tight risk tolerances. So what we have here, these solid lines basically show where we have a collar hedge. Essentially, the stock is about $208, $209 a share right now. We have a downside hedge at $202 a share, meaning that if it were to drop about 3% or more, that position is fully hedged to the downside. And those hedges go through May of this year. So we've got about 50 days or so. But on the upside, we have upside to about 217. That's what this, and that collar is established by selling call options here, taking in premium into the account, using some of that premium to fully pay for this downside insurance and keep a little leftover premium. We were able to sell those calls for a net credit. But the bottom line is the economics, we have upside of about 4% over the next 50 days with no more than about 3% downside. If you annualize, which is a little tricky, I don't want to suggest this is a right way to look at it, but if you annualize that 4% upside over the next 50 days, that annualizes to a potential upside of about 30% annualized. Again, that would assume the markets keep going higher and higher and higher, and we keep rolling these out. We think eventually this party is going to end, and it's probably within the next short handful of months. But that, we think, is a very compelling risk-reward trade for a small portion of client accounts, all knowing that for much of our client accounts, we can keep in very short-term treasury bills at very nice yields. So that's just a quick glimpse on some of the recent trades and positions we've done in client accounts. And of course, we invite questions at any time from our clients. So I'd like to segue from that into talking about the theme or the aspect or concept of investing for income. Especially at market tops, people start to think about dividend investing and other forms of tried and true investing for income approaches as a safe way to navigate bubble markets or overvalued markets. That's actually a pretty tricky situation because during major drawdowns, those dividends can be more than overwhelmed by drawdowns in the values of the capital values of the stocks that pay those dividends and other things. And I'd like to highlight a couple of areas of relevance here as it relates to income investing. Just setting the backdrop of the whole dividend world. This is a long-term chart of the S&P 500 dividend yield. Here we are today at one of the lowest yields ever in the S&P 500 dividend at 1.34%. In other words, you're not getting much in the way of dividend yields to take on the risk of investing broadly in the stock market. So that's not a little known fact. People understand that, so they've oftentimes jump to other kinds of yield instruments to chase higher yield. For example, high yield bonds, which sound great, but they're also known as junk bonds. These are bonds that are issued by companies that are deemed to be rather uncreditworthy, but as long as the party keeps going, no problem. What this chart shows, however, is the incremental yield that investors in high yield bonds, high yield junk bonds are being paid over treasury bonds, super safe treasury bonds, for taking the risk of lending to a unrated or junk company. As you can see here, the spread of high yield bonds over treasuries is only about 3%, 3.15%. And that is one of the lowest periods in all of this history. All to say is that investors are not being compensated very much for investing in high yield bonds, as attractive as that name might sound. Moving along here, some of the things happening underneath the surface is that we're starting to see junk rated bonds start to default. This is a chart showing the rate of default in the leveraged loan and junk rated leveraged loan category. And you can see we've got a very notable spike here. Spiked back here and here. This is during the COVID aftermath. This is a concerning sign. So chasing yield can be a very tricky thing, especially when the shoe eventually drops, which we think it will. This next one looks at a Bloomberg article talking about private credit. There's been a whole explosion, and excuse the pun there, of private credit, which is basically lending by private equity and hedge funds that's outside of the banking system, private credit. And the headline here says a lot. Flawed valuations threaten the $1.7 trillion private credit boom. And basically, because these are private loans, they're not subject to the same kind of visibility in public markets and valuation in public markets. So investors in these kinds of higher yielding private credit instruments basically have wool over their eyes to a big degree in terms of what the value of the things they actually are investing in are. And what this chart shows is there's a widening gap between what public markets, visible public markets, are valuing these debt instruments at versus what the issuers, private issuers of those debt instruments, internally are marketing them at. And you can see there's a very, very wide gap here for a lot of these, meaning that investors in these things perhaps are being misled that these private instruments are higher values than what they truly are if subjected to a public test of valuation. These last slides really speak to some of the pitfalls of income investing, but there are many virtues. And as I mentioned at the lead into this video, we're going to put an educational series together. It's probably going to be a 4 or 5 part educational series. It'll cover things like dividend investing, getting into the basics of what are dividends, where do they come from, what are the trade-offs of dividend versus growth investing. We'll also talk about bonds, the various types of bonds, how bonds should be looked at and valued in an income-producing portfolio. We'll look at things like bond ladders as an instrument to target income for when any given investor or individual needs it for their needs. We'll talk about things like closed-end funds, which can be a vehicle type that are often pursued for income investing, but there's a lot of nuances there that investors should be aware of. So we'll provide some education about that. And then we'll look at things like some of the private instruments that I just talked about. One of the strategies we use here at New Harbor is covered call option writing. It's a really good way, in our opinion, to use volatility in markets to one's advantage to create income through the receipt of option premium income. So again, we're going to putting that together. It'll be launched probably in the coming month and a half, and it'll be probably a 4 or 5 part series. Really meant to be evergreen educational content that we hope will just add to our endeavor to educate and empower our clients and viewers. That's all I want to cover this week. Again, markets are closed tomorrow, the 29th of March, in observance of Good Friday. Our office, too, will be closed. We're going to take a long weekend, and we appreciate clients' patience that we won't be available tomorrow to answer phone calls or emails. But we wish everybody a great weekend. I want to thank you for watching. And please do like and subscribe to this YouTube channel. We hope you find this content useful. We always welcome your comments and feedback. But until next time, I want to wish everybody a great day, and thanks for watching.